All right, so let's talk about some of the jargon in my industry: custodians, accounts, and funds. OY instead of oh my. Okay, so I want to just kind of explain like custodians in particular. That's not a concept that I think a lot of my clients and people I speak with are familiar with. Not quite sure what that means or who those people are. People are generally familiar with what an account is, and funds to an extent. But I want to talk about how they all fit together. So I want to do an overview. So let's say here you are, and you're taking your money and you're going to put it into an account. If we're talking about a bank, that account might be something like a checking account or a savings account, for example. So there are analogs on the investment side. You can have like a taxable investment account that's known as like a brokerage account, same thing. You could have an IRA account. You could have a 401k account through work. You can have a lot of different types of investment accounts. And I just want to point out that they are similar in concept to the different types of accounts that you can have at a bank. They just have different names because they do different things. So, and they're meant to do different things. The same way your bank accounts are meant to do different things. Your savings account is meant to grow your savings. You might get a decent interest yield on it. You might be penalized if you make too many withdrawals per month. It's designed for longer term savings. Checking account is meant to be your day-to-day expenses. Similar idea over on the investment side. You have different accounts that are designed to do different things. There are retirement accounts, there are non-retirement accounts, there are college savings accounts. There's a lot of different stuff, but just different types of accounts. Those different accounts are held with what's called a custodian. So, for example, in the banking world, the custodian of your bank account might be Chase Bank or Bank of America or Wells Fargo's, or maybe it's an online bank like Goldman Sachs, Marcus, or Ally Bank, or whatever it might be. You don't typically hear them referred to as custodians. You typically hear them referred to just as banks. But in the investment world, we typically refer to them as custodians. They are the ones that custody your assets. Your assets are your money invested in your accounts. So examples of custodians would be things like TD Ameritrade. I'm going to go ahead and X that out. TD Ameritrade no longer is a custodian for client accounts. Actually, let me do that. Let me do it here. TD Ameritrade no longer exists. They are now part of Schwab. But TD Ameritrade used to be a custodian until very recently. Charles Schwab is a custodian. Fidelity is a custodian. Vanguard, Altruist. There are lots of different custodians, just like there are lots of different banks. We just use the term custodian in the investment world. They are the institutions that have custody of your assets within your accounts. And so that leads us to the investment. So you put your money into your account is held with the custodian, and within your account, you will be purchasing investments or investing in investments. So these circles are representative of different investment, let's say either stocks and bonds or funds. So using the bank and investment analogies, within a bank, you might put your money in cash, or just leave it in cash. You might purchase like a certificate of deposit. You may purchase a bank product within your bank account. Within your investment accounts, you may purchase stocks, you may purchase bonds, you might purchase funds like mutual funds, ETFs, which are exchange traded funds. There's a slew of different investment products that you can use within your bank account. There are a slew of different investment products that you can use within your investment accounts. So if I wanted to kind of illustrate like one of those nesting dolls, like, peeling the layers of the onion back, you have your individual investments here in gray held within your account that is in teal. In turn, that account or multiple accounts are held at the custodian in pink. So the custodian is the one that holds your accounts. Your accounts are the things that hold your investments. So custodians have power. Custodians can control what they are willing to hold on their platform. So that's the next thing I want to talk about. Okay, so I want you to think about custodians like you might think about a grocery store, and understand that a custodian can control what they allow on their shelves, so to speak, similar to what a grocery store can do. So, in an ideal world, you can go to a grocery store and you can see many different brands offering the same things. Kroger is a large grocery store chain, I think nationally, but certainly where I am in Houston. And there are Kroger brand products at the grocery store. But Kroger doesn't limit you to only purchasing Kroger brand products. They may make them more attractive, they may make them lower cost or whatever, there might be efficiencies there. But generally speaking, you're not limited. You could buy Kroger brand milk or you could buy some other national brand milk, right? In the investment world, custodians are the same way. Custodians can control what is stocked on their shelves to a very large degree. And over the last 10 years, probably even longer than that, it has gotten significantly better for you and me as the end investor, because they've started doing what's kind of known as open architecture. Decades ago, 2+ decades ago, they may have been extremely limited. If you wanted to buy an investment product or use an investment product at a given custodian, you might be relatively limited to buying their own brand of stuff. And in recent years, there's been a lot of pushback about that from customers and clients. And so they've started doing what you might call open architecture, where they've started letting their competitors on the shelves with them. And the trend has been towards free services. So things like no account fees. So if you want to open an account at a custodian, many times there's no fee to either open it or to maintain it. No trading commissions on a lot of things. If you want to buy and sell stocks or buy and sell ETFs or options, a lot of these custodians have moved to no commissions. They give out, air quote, free research, free tools, et cetera, et cetera. But if you just stop and think about it for a minute, if something is free, then you are the product. And in this example where I'm talking about the custodians, oftentimes your excess cash is the product. The custodians are not just like there for charity, and they're not there to hold your assets and not earn money on you as a customer. So that's why I put free in red. It's not free. They're going to figure out a way to charge you and to earn money off of you. And oftentimes what's happening now is that the excess cash that you have in your accounts becomes the product. So a couple of primary examples of this is that a custodian, if you just have idle cash sitting in your investment account, they're going to take that cash and go invest it in a bank account on your behalf. And if that bank account is paying them any interest, let's say it's paying them 1% now, you're probably not going to earn that 1% on that cash yourself. The custodian itself is going to take and keep a significant amount of the interest that you're supposedly getting on your cash, and they're going to pay you a lot less. So this is one reason to try to mitigate the amount of cash that you keep within your investment accounts. Another way they can do it is by limiting the investment options, in particular for money market mutual funds. So you recall earlier that within your accounts, you hold investments. They could be stocks, bonds, mutual funds, ETFs, lots of options for things to invest in your accounts. Generally speaking, they have become more open architecture. The custodians have started to allow a wide variety of brands. They'll have their own brand of stuff, and then they will also have competitors' brands of stuff. One place where they may limit it, and it's becoming more relevant lately as interest rates have gone up, is for money market funds. People want to park their cash, say maybe not in a bank account because it earns very little interest. Maybe they want to go to a money market fund that earns a very attractive rate of interest. Well, the custodian might limit and say, well, you can only use our brand of money market fund, and we're going to charge an annual fee, just like any other investment product. They all have fees associated with them. But they're going to limit you to using theirs so that they can make money off of your account and existence. So I just bring that up to say none of this is free. And when they tell you something is free, of course, Nothing is free. You're the product. Your cash is the product. So you just need to be aware that these are some of the ways that they are actually making money. All right, so you're seeing this and you're like, okay, well, now you've gotten me sufficiently angry about this, and I'm really bothered that the custodian is going to force me into their products in some cases if I want to use a certain type of product. What can I do about it? Well, here's option one. Here's you, the client. You're going to have your investments. You're going to put them into an account, and you're going to hold those accounts with one custodian. Another option is that you could have multiple custodians. You could take money and put it into investments over here, which are in these accounts at this custodian. And you could take money and put them in different investments over here in those accounts with that custodian. And what you might be able to do is say, I have the cheapest options for these investments with this custodian, and I have the cheapest options for these investments with this custodian. Or in scenario one, you could just aggregate everything together and know that you're getting the cheapest or relatively cheap options for these investments, with the exception of that one. Like maybe that is your money market mutual fund. So here you have your stocks and your bonds, and the fees are managed. You're able to use any brand that you want, or not, maybe not any in the universe, but you have an extremely wide variety of investment choices and selection to make, and you can use different brands. But for that money market mutual fund where you're parking cash, they force you to use their version of it, and it's not the cheapest one. So what is the trade-off? Well, number one, you should be paying zero fees for the accounts and for just existing at the custodian in all cases. So that should really not even be a consideration. We should just really be focusing on the investment fees. So what does that mean? Well, at every custodian, you're going to have a login. You're going to receive statements. You're going to have a service center to call to deal with when you have issues or need things done. Like each custodian is its own grocery store, let's say. Over here, if you go to use different custodians, then you just have to know that there may be a little bit of extra stuff. You have separate logins for each one. You'll receive separate statements from each one. You'll have separate service centers. It's sort of like if you have a grocery store that you like to go buy 90% of your groceries at, but they sell expensive bread that's only Kroger brand, let's say. Well, some people might say, I don't like that. I don't want to pay for that expensive bread that's Kroger brand, and therefore I'm going to be the person that says I'm going to go to Kroger for a certain segment of my groceries, and I'm going to go to Randall's for a different segment of my groceries, and I'm going to buy most of my stuff at Kroger, and I'm going to buy a little bit of my stuff, like the cheaper bread, at Randall's over here. Same thing with custodians. You could have it all in one place. Understand that you may pay more for their branded stuff in certain cases, and maybe you'll have a consolidated set of logins and statements and service and all that kind of stuff, versus you may decide that it's not worth it to you to pay more for a given product at that one custodian. So you're going to separate your accounts and separate your assets and have them at different custodians so you can get the best deal. I don't have a dog in the fight. Do it any way you want, but that's just an example of how it might work. So let's look at a hypothetical example that is not an actual situation, because I want this video to be able to be posted for a long time. Let's just say, for example, you have a certain fund that you want to purchase, and your accounts are at custodian number one, and that fund charges 0.34% per year. There's this other fund at custodian 2. You can't buy this fund over here. They block it. You can only buy their fund that costs 0.34%. Custodian 2 has a cheaper fund designed to do the same thing. It costs 0.15% per year, and you could go over here and get that second fund. Well, let's look at the annual cost differences. So the difference in costs is 0.19%. So we're taking 34 basis points, we're subtracting 15 basis points, we're left with 19. So if you invest $10,000 in the fund, you could save $19 per year by having it held at custodian 2. If you were to invest $100,000 into that particular fund, you could save yourself $190 per year by having a separate account and set up over at Custodian number 2. And if you were to invest $1 million into that fund, you could save yourself $1,900 per year by owning that fund at Custodian 2 instead of at Custodian 1. So maybe that helps you frame in your mind whether it is worthwhile to you to have everything at one place where you know that you're going to pay more than you would otherwise on their proprietary product. Or maybe it shows you that you'd like to go ahead and use 2 different custodians, have accounts at 2 different places in order to save some cash every year. It's completely up to you, totally your choice. But hopefully that helps put it in perspective. So let me go back to the summary. All right, so in summary, you put your money into an account. That account holds investments inside of it. The account itself and any multiple accounts you have are held with a custodian. This is in parallel to you having like a bank account that might hold cash or a certificate of deposit and is held at a bank, which you could also call a custodian of the assets. So that's a way to look at the nesting doll. Your investments are held inside an account. Your investments are held within an account, and that account is held at a custodian. And the custodians can control what they put on the shelves in terms of investment options and even types of accounts that they're willing to hold. And largely, they have become open architecture, giving you an extremely wide variety of choices. But because nothing is free, there are situations in which they will limit your investment choices so that they can ensure that they're going to earn the fee on your accounts. And generally, the way they're doing that is by taking advantage of excess cash being held in your accounts. All right, I hope that's helpful. Thanks.